Preparing right now. All right. We are live, folks. Thank you so much. I told you I'd be live. I told you I would. And this is what we want to do. We want to welcome you to the Velocity channel where we're going to be going over some things, some questions that some of you have actually had. Okay. You guys have had some questions. And so we want to get those answered as well as maybe answer some questions that you have not thought of. As a matter of fact, let's go ahead and kick this off with Richard. He is back. All right. And we want you to give your undivided attention. As a matter of fact, we may need to give you some time to get some pencils, right? Get a pen, get a writing pad, right? Or your iPad, right? A notebook. Take copious notes because what's going to be coming out of his mouth is going to be golden. He's already told you he's got the certifications, the licenses. He is a financial professional. I have no qualms in saying that at all. And you already know that. A lot of you have already commented on, man, how do I get in touch with them? How do I get in touch with them? He's like the president of the United States. You're not just going to get in touch with him, right? So we want you to
Just
give
a
your
lot less corrupt
undivided.
than most of our politicians, right? So I try to keep it real a little bit more than that. Not a high standard though. Not a high standard, unfortunately.
Very good, man. Very good. Rich, how you doing, man?
I'm doing great. I'm doing great, man. I just had the opportunity to have a great little camping trip with my daughter, so I'm feeling very revived and definitely excited to be back on your channel, man. I've become quite a fan, honestly, of what you're doing on the channel, and I think it's very needed. And I think that we have an opportunity to really kind of crack open this little financial onion, if you will, and take a real look at what's going on. We try to be straight up, but understand all the considerations. But we're pretty direct, and we're always going to call it how it is. And I think that's hopefully very well received by your audience and others.
Absolutely, man. Speaking of well received, man, the lenders have made something well received, and that is that term refinancing. That
Mhm.
term refinancing, they have made it to where people they think that, you know what, we can save money by refinancing. I wanted to get your thoughts on refinancing. Is there something that people are missing with that term? Because we've always gotten it pitched to us that refinancing is the way to go. But is there something that we need to look at before we start refinancing?
Sure, sure. Well, okay, let me make a little disclaimer here in advance, okay? Having been in this industry 30 plus years, as a planner and advisor, but having been in and around the mortgage company and mortgage industry and owned several brokerages myself over the last 25 years, what I'm about to say is probably not going to make me ultra super popular among most traditional loan officers. But I want to add the caveat, okay? Been actively involved in the industry. I'm still a huge proponent for it. And I'll use a little bit of a sidebar example. Okay. My dad was a contractor and was in the construction industry his whole career. And he used to give me a great expression many years ago. I might have shared it with you or at least a small portion of your audience in the past. But he said, when you're a hammer, everything looks like a nail. And at the time, I'm sure I was younger and that didn't really resonate with me a lot. I'm like, what the heck's he talking about? Okay. But it means for good or bad, when there's something we do or that we represent or that we specialize in or that we offer, we tend to say that means what we're doing is what's best for everybody. Okay. We could look at the medical industry, right? Before we get into the financial industry. I think there are a lot of uh, various products, solutions, methodologies in the medical space that benefit people. Okay. And I believe in integrated medicine. I think there's a place for traditional medicine, drugs and surgery, and also a holistic approach, right? I think that integrated medical position is very balanced. On the other hand, I believe that chiropractors play a role in that. I think kinesiologists do. I could go on and on. I think they all have their proper place for the right person, the right situation. However, it is the natural human instinct. And everybody that's listening to this knows because they've experienced this in their own lives, right? And I have a lot of respect for chiropractors. But let's be fair, if somebody is a chiropractor and that is their primary, their singular focus in this space, they're going to understandably convince you that 90% of your problems are because you have subluxation, you get your back adjusted. Okay. I'm not saying that's right or wrong. I'm just saying when that's the view, this is what I do. So I've got to convince you that this is the solution. Again, anybody's a chiropractor, don't please take offense that I'm just using an example. Okay. If you're dealing with a traditional doctor whose primary focus is drugs and surgery, well, their first go-to perspective is going to be that you need this drug or we need to cut this X, Y, and Z out of your body. And there very well may be a place for that. Well, the problem is our industry has become largely the same. And this is a human behavioral thing, right? There's a lot of psychology that goes in to business, to sales, and being a consumer. I will tell you, I take a much more reality check approach to the psychology of what makes us do or not do what we should do, right? It's not all math. And I'm going to say this, especially for the men watching this, okay? People make decisions emotionally. They largely justify them logically. Now, you're going to get men that are going to say, oh, I'm not emotional. I don't make emotional decisions. Yes, you do. It might be ego. It might be pride, a different type of emotion, but we still tend to make them based on those perceptions we have, that experience we have. Now, what does that have to do with the mortgage industry or the refinance space? Well, again, is there a important place in our financial landscape for the average consumer, the average family to be able to refinance? Sure. Would I say carte blanche, it's the answer to every problem? Absolutely not. So let's clarify. Yes, there are scenarios where somebody is drawing money out of the equity of their home and they're putting that to work, i.e., they're going to do some significant improvements, or they need a new roof, or they need new windows, et cetera, renovate their home. Okay. And it's going to actually respectively increase the value of their home. Sure, that makes a lot of sense, right? You could definitely argue for that being a very good justifiable reason. Or they're going to consolidate a lot of higher interest, largely maybe revolving non-tax deductible debt. Sure, that could make sense too. So I'm not ignorant to either of those facts, but I'm going to tell you another thing. When you're a hammer, everything looks like a nail, which means you have to take a moment. And I say this to my fellow, mortgage and brokerage professional friends, et cetera. Refinancing is a tool, but I'm also going to say, probably going to get some flack for this. Most, not all, but most, and by most, I mean the vast majority, I'm afraid, that are in the mortgage space that view themselves as mortgage planners, right? Or strategists, et cetera, are not. And I say that with respect, but, and there's some brilliant people in our industry, so I'm not trying to offend anybody, but 30 plus years and 13 licenses in this industry has taught me a couple of things. And that is, when you're looking to be a long-term trusted advisor and you've come from the financial planning and advising perspective, where it's not how the solution fits your problem or solves it today, it is a piece of the puzzle on the road to helping you achieve a greater long-term success or result long-term, okay, over the long haul of your financial picture. So when it comes to refinancing, three important things. I've already outlined that there are some viable reasons to do it. But I will not say that just simply lowering your interest rate is among them. That can be a factor. But if the only reason somebody is refinancing is because they're going to lower their note rate and therefore their payment, that is not necessarily a good enough reason. I'm not saying it's not. There's a lot of particulars, right? There's going to be variations to everything we're talking about here. But I'm just going to speak a little truth here. The reality is, and there's exceptions again, but 74% of people that have 23 years or more, when they refinance, CJ, what do? They go back to how many years?
Zero.
30.
30, yep.
Right?
They go back
Now
there.
ask yourself the question, everybody. Just, I'm going to say the good, then I'm going to say the bad, and we're going to balance it out, okay? If I'm adding 4, 5, 6, 8 years to the length and therefore the duration of your financial obligation, whose advantage is that to fundamentally? Yours or the bank's? Because it's not yours. Number two, if you have to increase the cost, I've done 1,300 personal loans. You know how many people actually wrote a check to pay those closing costs out of their pocket? Like about one, right? because most of the time it probably doesn't make mathematical sense. There's a lot of arguments there. But the point is, if you're adding, especially in high cost states like Florida, like California, like Texas, like New York, et cetera, there's a lot of cost involved. Doc stamps, intangibles, title costs, promulgated rates, et cetera, et cetera. Even if the person doing your loan charged you nothing, there are still a lot of costs. It's not a crime. I'm just stating a fact. So if adding 4, 5, 6, 8 years to the length of your loan is clearly much more so to the advantage of the bank than you, well, adding 6, 8, 10, 12, even $15,000 or more to the size of your loan certainly also is not to your advantage. Although we understand sometimes there's you give to get, okay? But then you also reset the clock. Now, it's not actually a completely accurate statement to call it front-loaded interest because it's just the way that amortization schedule is specifically structured. But you are, in fact, resetting the clock on that amortization schedule back to day one. So that means a smaller percentage of your future payments are actually going to go to principal than interest, even if you reduced your note rate. And this is a simple term, but I want to make sure we really clarify. Your note rate, as prescribed in your note and your documents, is simply the rate that your payments are based upon in a given amortization schedule. Your APR, your annual percentage rate, is really just a function of all of your upfront costs factored into a interest rate for disclosure purposes, for legal compliance reasons. But your payment is predicated on the note rate. The APR just tells you how much it costs you to actually facilitate that loan. But interest volume is the number one element that determines true debt service cost, and therefore effective interest rate. Now, when you look at your truth in lending statement and it shows you how much you're actually going to pay back, and on that, say, $200,000 loan, you're really going to pay back $431,677. Well, that's what the true cost of that loan is.